Well, over the past few weeks, we have been highlighting some of the world's top hedge fund managers from Bloomberg Markets Magazine's 2014 Hedge Fund 100 list. These are the funds that had the best performances of the year. And today, we have Man Group President Luke Ellis. Man Group is the world's largest publicly traded hedge fund, and its flagship AHL Diversified Fund was up, wait for it, 32% in 2014, ranking number 5 on the list. Luke, welcome. Luke, how'd you do it? 32%? It's a big number.
Nice to see you again, Stephanie. Well, it was a good market environment for quant strategies. It was a good market environment for CTAs. The cross-market correlation was down across different markets back to normal types of levels, and that's really good for a CTA. And on top of that, the research we've been doing the last couple of years managed to add some, bit of luck and added some nice value on top of it.
Luke, how are you?
Hi.
And a pleasure to see you again. One of the questions that that's been, I think, really fascinating in the Man Group, you've developed this portfolio ranging from GLG, which is in the main human beings, all the way through to the AHL platform, which does a lot more sort of specialized and sometimes really cutting edge stuff. One of the things that struck me was evolution. One of your products does non-traditional investments. It will invest in things that haven't been really impacted by the huge crowds and by the governments. And then in the middle there you've got the diversified, which I'll call the more traditional CTA. And evolution was up about 20% over the last 3 years. Diversified has been running about 8.2%. Over the last 3 years, and candidly, the traditional fund, Jamel's fund, is down about 23%. So what we've really seen is some weakness on the part of human beings, and machines doing better the less they're trading in traditional assets. Is this a trend that you think might reverse, or do you think as the Fed slowly withdraws and markets turn back to normal, we might see better performance by the humans? GLG helped you last quarter.
Yep, I think you've got two different effects going on there. Firstly, last year was definitely a year for computers. And basically, the simple answer is computers can do more things at once. So, a computer CTA can trade 300 markets. Humans, not so much. In the end, humans trade 5, maybe 10 things at once. Similarly on the stock side, computers can look at 10,000 stocks a day. Humans, 30 or 40. So when cross-market correlations are low, the ability to look at a lot of different things is very valuable. And so, the diversification benefits really helped last year. That makes it a good time for computers. The other thing is that humans have a tendency to get bored of a particular market environment. So, fundamentally, this market environment's been the same for 4 years type of thing, maybe 5. And, we've had relatively cheap, if not free money, first from the Fed, now from Bank of Japan and the ECB, and that's led to very good performing bond markets, very continues the trends in equities, big moves in FX. Humans have a great tendency to want to say, I called the turn. Most of the correspondents who come on here want to tell you something's different. The reality is the market environment's been the same. So, the great thing of computers is they don't ever go to a cocktail party. They don't have to sound cool to people. They just do what the numbers tell them.
Except in 2013 and 12, CTA really suffered. So from a hedge fund investor standpoint, how do you know when to go CTA and not? People like to say, well, I trust Paul Tudor Jones, rain or shine. How can people feel that way about a CTA?
So look, I think the answer is it's part of a portfolio of investments, right? I wouldn't tell you that the only thing you should own is a CTA. I just tell you that it makes a lot of sense to have within a portfolio. The reason it makes a lot of sense is that when the opportunities are right, when correlations are low, CTAs will make a lot of money. As we saw, the discretionary guys, despite some big moves last year, really struggled to make good money. So really the thing is, CTAs will do well when correlations are low. Can I predict whether correlations are going to be low next year? No, I'm afraid I can't. I don't think anybody else can. But what I tell you is correlations are back to long-run historical levels at the moment. It's not like they're extremely low. It's just we had an unusual period when the Fed started QE, where we had sort of 3 years where correlations were particularly high. We've gone back to a normal environment, and CTAs work well in that environment.
How are you positioning for Greece? And which of the two will do better, humans or computers, through through a Grexit or through this highly uncertain time?
I guess it depends what the outcome is. If the outcome is different, if we really do get the Grexit this time, if we really do get a radical shake-up in markets, then those big turning points tend to favor humans. But if actually what we get is another muddle through, that really favors computers, because they're not trying to look cool again. So I can't tell you which will do better. The point of the firm is to have a variety of different investment techniques within the firm, and then to offer clients the different options to see what suits their own portfolio the best.
And when you say human traders, investors get bored, is it safe to say that here we've been in this pretty strong bull run, a very positive economic environment, and investors just don't seem to want to trade in the bull market anymore?
Yeah, you've got a lot of people who want to call the end of the bull market. Look, the reason Rubini's famous was because he called the end of one bull market. The next guy that calls the right moment comes on this program, tells you it's the end, it's going to be different. They're going to look very clever afterwards. But the number of people who've come on and said it's the end of the Treasury bull market over the last 3 years, quite a lot of people, right? And nobody quite remembers which were the ones that called it wrong. So humans always want to be there at the turning point. But when markets carry on in the same environment, which, if you ask me my basic view at the moment, we've still got money printing going on from big central banks in the world. Money is as close to free as doesn't matter. And in that environment, I think you get more of the same market environment, and so the trends will continue.
Do you think human beings have a hard time buying bonds with a negative yield?
Yeah. I think they have a hard time buying bonds with a 2% yield. And, look how well you'd have done if you bought bonds with a 2% yield. And yeah, we've all been trained in a world with, 4 to 5% bond yields as being the norm. So you have difficulty at 2%, and boy, you have difficulty at negative yields. So look, I can't tell you what the final outcome of this whole process is, but it's pretty clear that a number of central banks are going to keep money very cheap. And so, you shouldn't make an assumption that bond yields can't go negative. You shouldn't make an assumption they can't go more negative. They really can.
Let's talk about January, Luke. Why so strong? Was it the Swiss franc move? Is that what helped you?
Actually, the Swiss franc wasn't particularly interesting for us. Because the volatility, when it's a peg currency like that, the volatility is so low, we tend not to trade it in very big size. But, it created a lot of volatility across another number of instruments. As you saw, bund yields and other Swiss bonds were very good for us. So there were a number of opportunities to make money. Actually, Canadian interest rates were the best thing last month. That surprise rate cut really benefited us.
It seems that you're also on a very big marketing push. You've already got $70 billion under management. How big do you want to get?
It's not about a size. We have no growth targets. The point's about delivering returns and looking after our clients, and if we do that, then people like to invest in the products. So we don't have growth targets as a firm. But
Luke, then what has been the strategy? I've been my old team at Merrill Lynch now has a Man business card. The guys at Numeric, there's an excellent team called at Pine Grove that was really well marketed and well constructed. Fund of funds that they had with the credit focus. What's the objective in the U.S.? Are you trying to become the go-to provider amongst middle and lower end as well as institutions in this in this part of the world?
Sure. I mean, I think the goal of the firm is to have as many high-quality investment teams that are differentiated as we can find. We don't want to do one of everything. We're not trying to do Me Too products. We're trying to do things where we can find a high-quality investment team, people we like, people we think can make top-quality returns, and then we want to add them into the platform. Then on the client side, it's a mixture of direct institutions for the large institutions and working with some of the retail wirehouses like your old shop, like Morgan Stanley and so on, where we don't want a direct retail business, but we can work with partners to provide them with product. We're a manufacturer at heart, and we're quite happy to pay other people to build the wide distribution networks.
All right, Luke, well, congratulations on a great year. Good luck with the year ahead. Thank you so much, Man Group President Luke Ellis.